Interest rates are headed higher and home sales are down this week in Southwest Florida. What's this mean for you as a buyer and seller? That's what I'll go over in today's market update starting right now. Thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and today I'll update you on the changes in our local inventory and housing market activity, as well as the latest updates on mortgage interest rates and what these mean for you as a buyer, seller, or investor. Plus, I'll dive into the macroeconomics around the US and globe that are affecting the markets and what to keep an eye out for in the news as we head into uncharted waters with the Fed's new direction with the monetary policies ahead for this year. But first, if you haven't already done so, please hit that thumbs up button and let me know you enjoy these videos, and maybe consider subscribing to my channel to stay up to date on the local and global news affecting our markets. All right, let's dive on into this week's local stats. All right, so for this week's 7-day market update, we are comparing the last week. My last market update, we compared to the week following Christmas and right before New Year's. So we did see those numbers drop significantly that week. It was down to 300 new listings, which is very low. This week, we are seeing a return back to the same stats that we saw last week. So last week, we went from 604 new listings. This week, we're at 600 new listings. So there's really no change there. And I'm not surprised. We are down significantly from the last several months, which we were seeing around 800 new listings coming on the market every 7 days. On the market during the 7-day market updates. Now we're down to the 600 range. So that is a continuing trend. Downward inventory is decreasing. Solds are also down 9%. So from 787 last week to 718 this week. 9% drop is significant, and it is showing that inventory levels are obviously very low, but also less people are starting to buy. And I think part of that is because, well, interest rates are starting to rise, and that is going to be something that a theme that will be coming up more and more frequently as we move forward with the Federal Reserve's new policies in 2022. Pendings are also up 21%. So we went from 1053 last week to 1277 this week, meaning that more homes again went under contract and are being taken off the market, at least temporarily, this week than they were last week, which is contributing to even less inventory on the market. Last week I started something. I wanted to do a total inventory breakdown. This week I'm going to continue that trend where I show you the actual inventory that we are seeing in the MLS based on the property type. So single families, last week we were at 2057 on the market. This week we're down to 1985. That is around 80 less listings in the single family home type. Condos, we went from 899 last week to 835. Again, another trend. Those are the two main ones, single family and condos. Condos does include manufactured homes, villas, townhouses, high rises, all of those. So that is down another 64 listings this week. So that's the same trend we've been seeing. This week, multifamilies actually did go up slightly, 2 listings extra, but considering there's only 70 on the market, or have been 70 on the market over the last 2 weeks, 2 is welcome. So, and then rentals, 3623 last week, 3633 this week, and an additional 10 rentals came on the market. So we are seeing an increase in rentals, and I think that is also going to start to increase, as well as we've been hearing that more and more investors are the ones buying the properties. I think the stats were around 25% of new home purchases, even the single family purchases, are investors now. So that's welcome news to see more rentals come on the market, because more and more people are going to need to rent, just simply because the interest rates are starting to increase significantly now. Interest rates for this week, 117. Last week they were 3.376. This week NerdWallet has it going up to 3.576. So that's up 20 basis points, which is a significant amount. Bankrate also has going from 3.44% last week to 3.52% this week, also up 8 basis points. So both now have them in the 3.5% range for the 30-year fixed mortgage. And those are set to continue rising with the Fed's rate hikes expected in March. Now, so for buyers, obviously this is going to have the most effect on you right now with the rising interest rates. Higher rates is obviously going to mean less purchasing power. So, just to give you an example, you can take a look at the chart below. But for every 1% increase in an interest rate, your buying power decreases by about 10%. So, if we wanted to keep your payments, monthly payments, around $1,500 a month at a 3% interest rate, your loan amount could be up to $356,000, which allows your purchasing power to the purchase price to go up to $445,000. Now, this chart is assuming that you're taking out a conventional loan and putting 20% down for that home. For an FHA, where you're going to have 3.5%, these numbers would obviously be different. Now, when you go from 3% up to 3.5%, your loan amount is going to go from 356 down to 334, and your purchase price, the amount that you can actually purchase for a home for, is going to go from $445,000 down to $417,000. So you're almost looking at a $30,000 drop there. Again, as it goes from 3.5% up to 4%, your purchase is going to go from 417 to 392. So now you're below the 400 mark. So a 1% increase in the interest rates, which we're already up 0.5% on average. We're at about 3.5%. We're about, a year ago, we were at the 3%. We're now at the 3.5%. So you've already lost about $30,000 purchase power on the total price of the home. You're going to potentially be losing another $30,000 again, going down to 392. So that's just to put it in perspective. Those interest rate hikes are expected to go up again. And you'll see in my 5-minute macro cycle that Bill Ackman, a hedge fund manager, is calling out the Fed right now and is calling for another half percentage increase in interest rates, simply to keep inflation under control. So I think in March, we're expected to see the Federal Reserve raise the interest rates, and that in turn is most likely going to raise interest rates for mortgages as well. Now, for sellers, what does this mean for you? Well, higher rates means less buyers, less competition in the market. So that could be a good thing for those of you who have been waiting to sell until the market started to shift and the competition started to decrease. This could be a welcome news for you, meaning that you are finally going to be able to sell the property if you have been waiting on that. And you'll be able to enter a market where it's a little bit less competitive. And we have started to see things cooling off. As you can see, there's less buyers purchasing right now from the stats that I just showed you in the local market. It is still competitive out there, but we are seeing less, highest and best offers, things like that. On the other side of the coin, less competition equals slow or no or even negative price growth, depending on what happens with the economy. So as buyers start to lose their purchasing power, prices will slow or may even decline, decreasing your leverage to negotiate as well as your own purchasing power when you do decide to buy. So, a lot of sellers right now have a majority of the leverage. As demand starts to decrease, you're going to start to lose leverage. It's what's called a shift in the market, where we're in an extreme seller's market right now. We will start to see a shift over to less of a seller's market into, there's a potential chance for it to go to a buyer's market, but things need to still change quite a bit before that happens, that kind of shift. And for investors on this, for the appreciation chasers and the flippers out there, rising rates will most likely slow demand in the coming months, which is going to reduce the appreciation rates that we have been seeing over the last year and a half. But I think this is also going to mean that your window for profit is starting to close. You're going to need to start factoring in the slowed growth into your deal analysis and be more careful with the types of deals you take on. Earlier on, because we had so much growth quickly, you were able to take things and buy a vacant lot for what was probably a high price at the time, and then you could flip it and turn it around in 2 or 3 months and sell that same piece of property, for another $10,000, $15,000, $20,000 after you pay your fees and your closing costs and all that stuff. So I think with this slower increases in appreciation or even a decrease in demand, you're going to have to be more careful with that. You're not going to be able to factor in as tight of margins as far as what your profit is. And then for the other investors out there, the buy and holds, I mean, this is your market. So rising rates means more buyers are going to need to rent. Inflation is also making it easier for you to pay back your mortgage, especially if you just recently bought in the last year and a half where interest rates are extremely low. Guess what? If as long as you purchased with a fixed rate, which I hope everyone did, because ARMs right now are going to be very tricky, especially with rising interest rates. But if you did get a fixed rate mortgage, guess what? Your mortgage is staying the same, and inflation is actually giving you it's decreasing your purchasing power if you're purchasing, but for you, it's actually making it easier to pay back your mortgage. So yeah, that going for you. And then on the same token, the because there's going to be more rent demand, you're also going to be able to increase your rental rates. So, and we're already seeing that. And in some places, it's crazy the amount of rent that rent is going up. The only thing that you will have to watch out for is the government stepping in for price rental bars on how much you can raise in that rent during a certain amount of time. Usually it's capped. So, all right. So I'm going to try to do this a little bit quicker this week. I'm going to do a 5-minute macro series. I just want to real quick lay out the macros and try to keep it under 5 minutes so I don't go on and bore you guys. So you guys can all get the information quick and be in the know. So first series, we're talking about Bill Ackman. As I said, he called out the Fed. He's calling for a 0.5 point rate hike just to regain credibility, because the Fed has really, I mean, if you've been paying attention to what they've been saying over the last year, they really have had no idea what's going on in the market, and they're just kind of saying things and they're not really following up with it. So they've been telling us that inflation is transitory. Now they're finally worried, and now they're kind of looking like they're behind the eight ball. So he's calling that if they actually need to follow through with what they said they're going to do, which is to raise interest rates and decrease their bond purchases through March, and then that first rate increase. Goldman Sachs is also expecting 4 increases this year alone. Moving on, next story, California ports are congested. So we have a ton of imports that are just sitting out on these carriers out in the ocean. They're anchored because the ports in California have been congested. Luckily, they did finally install some fines for shipping containers that are being left in the cargo in the ports, and that has already started to reduce the congestion by 37% already. So it's $100 per day per container. So that's good news. At the same time, thieves in LA, which is obviously been in the news quite a bit. Thieves in LA are looting freight trains filled with packages from the UPS, FedEx, and Amazon. You can take a look at the picture here. It's just brutal, and honestly, it's kind of embarrassing and shocking. Next, Chinese real estate. So the dominoes continue falling, and I guess in addition to just going on the back of the freight train and the carriers, China as well has closed down their ports with COVID restrictions because they had an outbreak in their ports, and that has also worried people about people and the manufacturers as far as goods this year. It's going to be slowing things down, and it's imposing supply chain issues. So it's another thing. But moving on to the real estate sector in China, Evergrande did strike a deal where they were allowed to. They were actually extended. They were able to extend their debt, being able to pay back their debt. I'm not sure how that's going to work because they have already sold off all their contracts. So I'm not sure where they're planning to get this money from to actually make the payments on time with this extension. But that is, I guess, good news for them. I think it's just kind of kicking the can down the road to say. But in addition to that, the dominoes fell onto China's actually largest builder, which is Country Garden. Evergrande makes up 30% of the GDP, but China's actual number one builder as far as sales volume is Country Garden, and they have now seen their bonds plunge. They're having some debt issues as well. So the dominoes continue falling, and you can see that from the chart here as far as the dollar bonds hitting their record lows after the report of their pulled debt deal. And China has been continuously saying that, there's nothing here to see, there's no problem, and it's not going to extend or hit our shores or our markets. But it's starting to become a problem, I think, for a lot of places, and I wouldn't be surprised if it does. And then again, the last story here is the stock market. We are starting to enter into bear market territory. The stock market is down so far for the year already in 2022, and it's only been a few weeks, but it's already down on average about 2%, which is starting to show signs of a bear market. We also have rising bond yields as a problem. They're still relatively low, but it does pose a problem, so that's something to keep an eye out for. If the stock market does enter into a full-out bear market, I think things are going to change pretty quick in the economy, and people are going to start hoarding their money a little bit more, which is going to slow everything down quite a bit. So that wraps up this week's market update, and I hope you enjoyed it. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.